If you're enjoying this podcast from us here at Which, then why not become a Which member? Right now, we've got a special offer, especially for podcast listeners, meaning you can choose any of our 3 membership tiers for 50% off the usual price. Starting at just £39.50 for a full year, you can get Which magazine delivered direct to your door. For the same price, you could also choose a digital Which subscription, giving you access to all of our product reviews, the Which app, and the digital edition of Which magazine. What's more, you'll also be able to use the Ask Which service for personalised one-to-one buying advice. Or why not get a full access Which subscription for just £49.50 for a full year? Don't forget, that's 50% off the usual price. To join Which or to find out more, just head to which.co.uk/podcast offer. That's which.co.uk/podcast offer, or click the link in the description for today's podcast for 50% off a Which annual subscription.
The base rate has fallen, again, but with house prices still on the rise, is it harder than ever to get on the property ladder? Welcome to Which Money. Hello, it's James Rowe here in the Which studio, and joining us today we have Which Mortgages expert Sam Wilson. Sam, hello, nice to have you here.
Lovely to be here.
How are you? Nice to have you here.
Yeah, not too bad. It's been a while.
It has been a while. It's good to have you here. And joining us down the line from home is David Hollingworth from L&C Mortgages. David, how are you?
Hi, James. Good, thank you. Thanks for having me.
Good to have you back as well. It's been a little while too. I want to start with the base rate, Sam. I mentioned it in the intro there about it coming down. Give us the overview. How much has it come down by? When did this happen?
Yep. So on the 7th of August, so a few Thursdays ago, the Bank of England voted by 5 votes to 4, so quite a close vote, to drop the base rate by 0.25 percentage points. That's the same drop that they did in May of this year and also in February. So what has this meant for mortgage rates? So fixed rates have only come down a very small amount. So when we're looking at the average fixed rates, they've come down by about 0.01%. That's because fixed rates already take into account what the base rate is going to do in the future. And mortgage lenders predicted that this would happen, so they'd already factored it in, so we're not seeing lots of changes. It's different though for trackers. So for trackers, for people with a tracker mortgage, your rate is going to come down by 0.25%. And UK Finance predict that for the typical mortgage holder, that's almost £30 that you're going to be better off every month.
So it is a sizable amount once it starts to add up.
Yeah.
You said that mortgage providers almost predicted a fall from it going from 4.25 down to 4%. But as you say, it wasn't unanimous, was it? It wasn't a unanimous decision. It was pretty close whether or not it was actually going to drop.
Yeah, no, definitely. Well, we've had rising inflation, much above the target of 2%. But that's been, on the other side of things, we've had unemployment growing, the job market's not looking great, and also growth is a real concern about that. So we've really got a battle of whether the Bank of England's going to consider more the inflation figures or whether they're going to consider the labour market and growth. So yeah, it was arguably closer than we thought. The lenders were definitely pricing in that it was going to happen, but on the day it was really quite close.
David, what do you think it tells us that it was quite a close decision whether or not it was going to come down?
So it would have been more of a shock if it hadn't moved down, and that would have had more implications, I think, for mortgage borrowers. So if the cut that is expected doesn't come through, it could have knocked up the cost of funds for lenders. And what we see is that cost of funding moves through very quickly to the rates that are available to borrowers, whether that's up or down. So actually, fixed rates have continued to generally come down, but it is in really small increments. And although there may still be the opportunity for base rate to fall again, those reductions are already pretty much priced in. So fixed rates are not shifting that rapidly, but they are still moving positively downwards.
And we did have a bit of a milestone for fixed rates, didn't we? For 2-year fixed at least, because they've come down below that 5% mark for the first time in a little while. As much as it's a small reduction again, does this seem like a bit of a milestone moment?
Yeah, so the dynamic in terms of 2 and 5 year rates has been moving as base rate has come down. And so actually those rates you reference are average rates, but the very lowest rates now, 2 year, have dipped back below the 5 year rates. So for a long time, unusually, 5 year rates were cheaper than 2 year rates. But as the market has shifted downwards, as expected, the cost of funds to lenders is bottoming out, and the markets are anticipating base rate could fall a bit further, but ultimately will start to bottom out and stay there. So there's very little between 2 and 5 year, but 2 year is looking a little bit cheaper now.
And what do you think this will lead to in the housing market? Is it going to instantly lead to a bit of an uptick in the amount of people who are able to get themselves on the property ladder, or is it not as simple as that?
I think the challenges remain in terms of affordability. So the two issues for first-time buyers in particular, but not only first-time buyers, is having an adequate deposit and being able to borrow as much as they need. Now, lower mortgage rates will help instill some confidence, and so that will help the activity levels. And actually, even though stamp duty shifted and reverted back in April this year, although it brought some transactions forward, we've not seen activity levels drop off as you'd expect. And actually, Nationwide's house price index is still pointing to annual price rises.
We'll talk about affordability a little bit more, I'm sure, because there's plenty to say there. But David, you did mention stamp duty changes. Sam, to bring you in on this, can you take us back to April and sort of give us a bit of an overview about what happened to stamp duty in April this year?
Yeah, of course. So from the 1st of April, the stamp duty thresholds that had been in place since COVID times were removed, and they went back to what was previously in place. So what that meant was for home movers, you would have paid stamp duty previously from the amount over £250,000. It dropped to £125,000. So that brings a lot more people into paying stamp duty, or paying more stamp duty than you previously would have done. For first-time buyers, it could impact you in slightly different ways, and you might not see any impact, or you could see a massive impact. That's because there were two changes that happened. So the first change was there's stamp duty relief. That was previously on homes priced up to £425,000, and that relief was that you paid no stamp duty. That's dropped down to £300,000. And then for our really wealthy first-time buyers, if you'd purchased a home that was under £625,000, you wouldn't have to pay any stamp duty up to £425,000, and then you would pay the higher rate on the rest of the amount. That dropped to £500,000. What that means is there was a big cliff edge. It means that if you purchased a house from the April 1st that was £550,000, for example, you'd have no stamp duty relief as a first-time buyer, whereas previously you would have had some stamp duty relief because it was under that £625,000 mark. Now, obviously, that's impacting the wealthiest first-time buyers in the country. There aren't lots of people who are first-time buyers and looking at buying a £600,000 home. But the reality is that in the most expensive areas of the UK, we're looking at the southeast, London in particular, but also hotspots like Cambridge and Oxford. First-time buyers potentially would be paying those very high prices. So that could lead to massive jumps in stamp duty, and therefore increasing the cost of moving home.
And we did see a pretty realistic cliff edge, didn't we, in terms of house sales up in that run up to April the 1st, didn't we? I've not got the numbers.
Yeah, but don't worry, I've got the numbers here. So
give us the numbers.
It went absolutely wild. So we had over 170,000 house transactions in March. Next month, 64,680. So it's a massive decrease in April. But as David alluded to, they then recovered. So once we went through to June, there was 93,530 house price transactions, and that was actually 1% higher than the year before. So there was that massive dip. People were definitely trying to beat that deadline, but it has slowly come back, and it's now looking pretty similar to what we've seen in previous years.
David, what do you think has almost happened to the market since the stamp duty changes? Were people put off by it to begin with, and now are kind of over it and have priced this kind of thing in?
Yeah, so as Sam talked through there, I think the changes were definitely enough to incentivize buyers to try and get in ahead of the deadline. So that's where you saw that spike in activity, and stamp duty incentives have always resulted in that big spike of activity. You've always got some form of deadline or other before they revert back to what they're going to switch to. So you get that spike, but actually I think it wasn't enough to put people off. So if they were keen on buying, the difference in stamp duty wasn't enough that they would just abandon the idea altogether. And so actually that activity has kind of just moved along quite nicely and not dropped off and stayed low as we'd feared. Nationwide point to an interesting number. So because, of course, this house price growth is smaller and it goes up and down each month. If you look at different indices, some months will be positive, some negative. But actually they're talking in July that the annual rate of change was 2.4%, slightly up from June when it was 2.1. Actually, wages have been growing. And so whilst we've seen these smaller annual price changes, it has allowed people to catch up a little bit. Now, I'm not saying it's easy, but Nationwide points to the house price to earnings still being 5.75 times on the average. But of course, that is below the peak. So whilst it still sounds like a significant amount, which it is, and still presents significant challenges, it is down from the peak. So that is helping affordability, coupled with lower mortgage rates, of course, and base rates starting to fall a little bit. That will instill more confidence as time goes on.
What would you say when looking at average rate graphs since February, so since the start of this year, between January and February, we saw a little jump up in average mortgage rates, and then it's been quite a nice graph moving down. And I was just wondering what you thought the impact of mortgage rates moving down versus the stamp duty changes. Do you think the mortgage rates have really helped, or do you think actually that's not been a big factor in kind of helping the housing market still stay pretty active?
So whilst activity levels have been good, they're not rocketed like, of course, they did in 2022. So we're certainly a long way off that level of market. But mortgage rates coming down, base rate coming down, I think consumers have been waiting for that to happen. We've been talking about it for what seems like a couple of years, really. And whilst it was expected, it was taking a bit longer to feed through. But now that you can start to see where things are heading, I think those who are thinking about moving, those who are thinking about buying, can plan with a little bit more confidence. And lower mortgage rates, compared to the volatility, if we go back to the mini budget, for example, and when base rate was rising very rapidly, you can now feel a little bit more assured that at least interest rates are on a more level footing, and that base rate looks like it's still heading in the downward direction. So I think that that's really important, and that's probably, as you say, helped counter the stamp duty changes, which did see that spike in activity.
Well, should we talk about affordability? Because there is definitely still a sense from the market itself that they can try and do more to help first-time buyers, especially. Give us a flavour of kind of what they're doing to try and give people a bit of a leg up.
So what's generally been happening is that the bigger mortgage lenders are trying to increase the amount of money that they will lend you. So when they are stress testing your what you can afford, so let's say you have a mortgage that's 4.5%, they might stress test you against a mortgage that's 8% to make sure that you can afford the repayments in the event that the base rate went up and then the price of everything went up. And what they've done is they've dropped, a lot of these lenders have dropped those affordability tests, and that will allow buyers and remortgagers to be lent more money. So it is good news for people. House prices are still high and you often do need to borrow a lot of money. But there obviously is also that risk of an increased amount of borrowing and debts that you put on yourself. And that's definitely something that needs to be considered when people are kind of looking at it. Because on the one hand, it's great that you can borrow more money, but on the other hand, you do need to consider the impact of having more debt.
David, I'm trying to work out if this is a straight up acknowledgement from the market that maybe not enough from government is being done to help and they need to sort of step in, or is this something a bit different? What do you think the reasoning behind all this is?
I think there's clearly some government desire to see the market freed up. They've put housing very centrally at the heart of policy, and the ambition to build more homes is clear and evident, and they've set a very challenging target on that. In order to deliver that, though, I think you've got to have some help for the market in terms of how people can access borrowing to buy. And so many of the challenges for first-time buyers are centred not only on deposit, and these are two sides of the same coin, but deposit and also on affordability and how much people can borrow. So when you've got high house prices, people will need to borrow to the more extreme level, particularly first-time buyer, and take as much as they can get. Otherwise, they need an even bigger deposit. Now, the regulator has responded to that perhaps governmental desire by clarifying that now we're in a downward rate trajectory, that lenders may have a bit more flexibility in how they establish their stress rates than they'd perhaps previously been employing. And lenders have grabbed hold of that and said, yeah, sure. If we've got that flexibility, that clarification has helped them reduce those stress rates. We've also got this desire to increase or change the parameters around what kind of percentage of lending lenders can do at higher loan to income, so income multiples. They've got limits on how much they can do over 4.5 times. And there's now more flexibility there too, which again, lenders are looking at how they can use that and perhaps in practice help more borrowers to get the kind of borrowing that they need, rather than imposing limits and caps on what they can do. So as Sam said, I think it's really important. Individuals do need to think about what's affordable. Lenders are still going to be applying rigid affordability tests. They're going to be looking over what your income and outgoings are. But there's just more flexibility in where they might get to for those borrowers that can justify how much they can afford.
I was going to say, it definitely seems on a surface level like a good thing to try and bring more people into the housing market. But then is there that sort of concern or danger that if mortgage rates were to increase 2 years or 5 years down the line, when people were to remortgage and those affordability checks weren't as rigid, is there going to be some concerns around what kind of impact it might have on people if rates were to go up again?
So stressing of affordability is still happening. It's just that lenders are using different rates. So I think you're right. You can look back at the rules and how were put in place to make sure that there was some headroom. And when we've gone through a period where interest rates have risen very rapidly, you can clearly see that some households will have definitely been helped by the fact that they were stressed at much higher rates, particularly when we came from those ultra low rates that seem way back when now, but when borrowers were benefiting from 1-2% on mortgage rates. So I think it's not abandoning that concept, and it's same goes for the loan to income proportions and the higher multiples. But I still think borrowers should think about, what does this actually mean? Just because I can get it, do I feel comfortable with being able to borrow that? overstretching yourself and then finding that you've got no slack to play with if rates do change, and let's face it, we don't know what will happen in the future, then of course it is important to look at what your budget may or may not be able to take on.
And when we talk about mortgages in terms of the percent of money you're actually borrowing for the property, 100% mortgages almost seem to be becoming, I wasn't going to say overly popular, but certainly more and more of them are coming on the market. This is relatively new, and is it appealing to some people in terms of getting a bit more for their money?
Yeah, so I think it was back in the spring that we saw two lenders bring out 100% mortgages. I can understand that from a first-time buyer perspective, especially if you're renting in an expensive city, it's difficult to get enough for a deposit. But again, I think we come back to those considerations around what you feel comfortable when it comes to debt. For some people, that might be okay, but to borrow 100% it's a lot of debt to put on someone. And as we've said, rates can change, your personal situation can change, so there's lots to think about before taking on that much debt. Also, when we're looking at the rates, they're often much higher, which makes sense because the lender is taking a much greater risk than if you were to have a 10% or even a 5% deposit. So what that also means is, for a first-time buyer, you would be paying much higher. You're going to be hit by two things. You're going to be paying much higher monthly repayments because you're borrowing 100% of the loan, and then you're also going to be paying more because the rate on that loan is more. So it's really difficult because we want to be helping people to get onto the property ladder, and it is good to see lenders coming up with innovative solutions, but you really do need to just go through all the scenarios and think about the monthly repayments before taking on something that may at first glance seem great, but then when you look at the numbers, it might not look quite as appealing.
David, is this something that you would naturally speak to your mortgage advisor about, trying to strike that balance between the amount you can stretch yourself for a deposit versus how much those monthly repayments would end up being, depending on how big that deposit was going to be?
Yeah, I mean, look, they attack the problem that first-time buyers face in terms of finding it hard to save a big enough deposit to actually access the market. So those borrowers that are well suited for 100% mortgages are going to be those that have got good affordability, so they can show that their income is going to cover the mortgage payments adequately, and therefore the amount that they can borrow is not necessarily the big problem. It's that they're trying to save for a deposit whilst they're also stumping up for a high rent, perhaps, and just that is taking time. All the while, house prices may be just edging higher, and so they constantly feel like home ownership is just moving further away. So 100% or other high LTV options, those are the kind of deals that could help accelerate their ability to access the market and actually get on the ladder. And so I think they are useful for that type of borrower. But when we're talking about those high income multiples, they're much less likely to be available on these very high LTV products. And when I say LTV, I mean loan to value, so smaller deposit deals. You are going to need to be able to show that affordability, and don't be expecting the 6 times and beyond kind of income multiples that you will see available for those with some deposit, even if it's relatively small. So I think they serve a use, and of course deposit is a massive problem for first-time buyers. It's just so hard to be saving that kind of money alongside all the other day-to-day costs. So they can help speed things up for people, but they won't be right for everyone.
And with all this in mind then, Sam, where does the government stand on this? We touched on it a little earlier, didn't we, with David, around the government's stance on the property market as it is. Obviously, they've got very big ambitions for house building and getting more people on the property market. But where do these stand? Are they concerned about the affordability for buyers?
Yeah, I think it's clear that they'd like to encourage lenders to try and come up with innovative solutions. I think they clearly would like to build more homes to help the supply issue, but ultimately these affordability issues aren't going away. We'd need a massive increase in supply to really drop house prices to the amount that would make them affordable to many more first-time buyers, and also we would need some more innovative solutions when it comes from lenders to make more first-time buyers able to enter the market. So I think it's encouraging to see changes. It's encouraging to see new products, new ideas, new changes to regulation. But I think it would definitely be interesting to see in the autumn if there's further changes, if there's more momentum on kind of what we can do to make it easier for first-time buyers and people looking to get onto the property ladder. I don't know, David, whether you've heard from the FCA or talking to lenders, whether in the autumn there are potential changes or whether there's a potential timeline for new solutions or consultations to come in to possibly try and tackle these issues.
Yeah, I mean, it's certainly front and centre, and the regulator is looking at ways that it can make mortgage lending more accessible. So some of the changes have come in really quickly, and lenders have been very quick to adopt those. So I think in a very competitive market, lenders are really keen to do what they can. And I think these are making real differences. So I think first-time buyers who perhaps felt that it was still quite a long way away for them will actually be able to revisit the market, well, now and into autumn, and say, well, look, do I need to recalibrate how much I can borrow? Is it actually closer than I previously thought, with the changes that have already taken place and anything that may happen in the future? And of course, what that may do is help stimulate some more demand. That will help encourage more supply. But the government does need to be starting to ensure that added supply is feeding through, because if we just continue to extend the level of borrowing that people can get, we may risk the chance that we just inflate prices higher if we don't balance that off with increasing supply. Currently, there's no signs of that, but of course, that is a very delicate balance that you need to maintain.
And when we talk about looking ahead to the autumn, obviously we're talking about any future base rate decisions and, of course, the Chancellor's budget as well. We'll be covering both of those, of course, here at Which. This is such a meaty topic. There's so much to cover, and we naturally haven't got all day. But just to the pair of you, before we wrap up, anything else we should touch on? Anything else we should consider in terms of whether it is the property market or affordability? Anything that jumps to the front of your mind, Sam?
So I think that the thing that jumps to mind is actually something that we haven't really touched on, which is people are looking to sell their house currently. So kind of just moves slightly adjacent in the property market. So with all of the changes that have happened, we haven't seen a lot of buyers compared to others. The buyer demand has completely dropped off, but there's not loads compared to the amount of supply, which means that Rightmove, other property indexes, other property websites are really pointing to pricing your home at the properly and looking at the market, looking what's around is really, really important in order to attract buyers. They found that buyers are they're able to spot a house that's actually not quite priced right, that's actually a little bit unrealistic for the market and for the area. So if you are a seller in the current market that we're in, it's really important to look around and make sure that your house is priced realistically. Otherwise, you probably won't see a lot of prospective buyers taking a look.
David, any final thoughts from you?
Yeah, I think there's lots of interesting things happening. There's breaking news around, will there be more property tax to come? And as you say, that's one for us to keep an eye on rather than speculate too much at this stage. But yeah, great point from Sam. I think, this is a very competitive lending market, that's for sure. So borrowers have got much better rates to go at, whether they're looking to stay where they are and remortgage or whether they are making a move. And I think we will hopefully see more activity in the purchase market. But as Sam says, that is critical. You do need to be realistic, and if you price it right, there will be a buyer out there. But this is probably still a buyer's market at the moment.
Well, we've covered quite a lot today, for sure. If you want to catch up on anything we have spoken about, we've got loads of free guides and free advice on the Which website. We'll pop some links in the show notes. But for now, David, thanks very much for dialing in from home.
Thanks for having me.
And Sam, thanks for joining us here as well.
Thank you for having me.
Thanks for listening to this podcast from Which, the UK's consumer champion. You can find plenty more advice about what we discussed today in the show notes. There you'll also find a link to become a Which member for 50% off the usual price, an offer exclusively available to you, our podcast listeners. Joining Which will not only give you access to all of our product reviews, our app, one-to-one personalised buying advice and every issue of Which magazine across the year, but you'll also be helping us to make life simpler, fairer and safer for everyone. Don't forget to hit subscribe wherever you're listening. That way you'll be notified whenever we release a new episode of Which Money, Which Shorts, or another podcast that we make for you. And if you want to get in touch with us, then follow us on social media. We're at Which UK, or you can drop us an email to podcasts@which.co.uk. See you next time.
Do you want to reduce your energy bills? Or maybe you want to use greener energy? Go solar and get a discount. Right now, Which members can get a 7.5% discount on solar panels and their installation if you use Heatable, a Which trusted trader approved service. You can also include a storage battery and EV charger, handy if you're looking at making the switch to an electric car. To make use of this exclusive offer, simply head to which.co.uk/solar-offer. That's which.co.uk/solar-offer before the 30th of September 2025. And if you're not already a Which member, you can grab a year's membership for 50% off the usual price. To do that, go to which.co.uk/podcast offer to get involved. Start your solar journey today. Go solar and get a discount with Which.